How to use the CCI indicator in your trading strategies. Hello, colleagues. This is David, the leading Binarium analyst. Before we dive into the topic of today's video, I'd like to ask you to leave a comment below, letting me know which indicator you'd like to learn about next. I'm looking forward to your suggestions. And now let's begin. I'll be using the Trading View chart within the Binarium terminal. In the Indicators section, I type in CCI and select Commodity Channel Index. The Commodity Channel Index, CCI, is an oscillating indicator used to identify trend reversal points. Initially, the CCI was created to identify cycles in commodity markets, but it has been successfully applied across all financial markets. The indicator measures the deviation of an asset's price from its average price over a specific period of time. However, unlike the RSI, the CCI is not confined to a fixed range of values and can fluctuate both in the positive and negative zones. Let's review the CCI values. Like other oscillators, the CCI is displayed in a separate window and oscillates around the zero level. Specifically, a value between -300 and -100 indicates a downtrend, which is likely to be reversed by buyers soon. A value between 100 and 300 signals an uptrend, which is likely to be reversed by sellers. Let's look at an example. I opened a trade on the upside as the price chart broke out of the previous trading range on a strong impulse, and the CCI indicator continues to go into the zone of values above 100. This indicates an uptrend that may soon be reversed by sellers. The indicator just reached this zone, so I had time to open a short-term trade on the upside. But if the indicator had been fluctuating between 100 and 300 for a long time, a pullback to the downside would be a more realistic scenario. Now we can see that the chart has reached a resistance level and stalled there. The CCI showed that opening buy trades was already too late, and it's time to wait for a reversal and look for an entry point to downside. I opened my trade in time, that's why it closed in profit. The CCI can be used to identify overbought and oversold conditions. What does this mean? Read on for more details. When the CCI rises to values between 100 and 300, it indicates an overbought zone. In this case, a downward reversal is possible, and it's better to enter the market on the downside. When CCI is in the zone from -300 to -100, it is oversold. A reversal upwards is possible, and it is better to open a trade on the upside. Let's take the euro to US dollar asset as an example. In this case, the price isn't rising or falling, fluctuating within a narrow range. The CCI indicator remains below -100, indicating oversold conditions and the impending end of the downtrend. In such a situation, you can expect a price reversal upwards. Another way to use CCI signals is to identify strong trends. For example, when the CCI crosses above 100 and stays in that zone, it may signal the start of a strong uptrend. Conversely, when the indicator crosses below -100 and remains there, you can assume the start of a strong downtrend. In this example, we see the price chart preparing to settle into a lower trading range. The CCI indicator suggests entering the market with a sell trade, as we observe the testing of the -100 level, followed by a breakdown. If you've watched up to this point, let me know in the comments that you find this video interesting. The third way to use CCI signals in trading is to search for reversals through divergences between the price of the asset and the indicator's value, known as convergence and divergence. Convergence occurs when the price of the asset continues to fall, reaching a new low, while the indicator begins to rise. Convergence signals a weakening downtrend and a potential upward reversal. Divergence is when the price chart continues to rise and reaches a new high, but the indicator falls and shows lower highs. This may indicate a possible downward reversal. Let's analyze some examples, starting with convergence. In this chart, we see the price fluctuating within a range without moving higher or lower. A solid price support has formed. However, the CCI indicator disagrees, trending upward and outpacing the price chart. In this case, the asset's price is falling while the indicator is rising, signaling a convergence, which suggests an upcoming upward reversal. Therefore, the correct move here is to open a trade on the upside, which is exactly what I did. Also note that a new trading range has formed on the chart. Let's take a look at how a divergence signal plays out in a real situation. So after the price chart reached its high, it continued to move within a narrow range without going higher or dropping lower. Meanwhile, the CCI indicator, as we can see, started moving downward, slightly ahead of the price chart. This is divergence, and as I mentioned earlier, divergence signals a downtrend. Therefore, I opened a trade to the downside. As you can see, the prediction was accurate. After a brief sideways movement, the price chart dropped sharply and the trade closed in profit. Now, please share in the comments if my explanation of convergence and divergence was clear to you. Let's summarize. The CCI is a classic indicator for technical analysis in both commodity and financial markets. The advantages of the indicator are, it's good for analyzing trends and identifying reversal points. It can be used on different time frames, from minute charts to daily charts. It helps identify divergence and convergence signals, which indicate trend reversals. CCI also works well with other indicators. However, there are also disadvantages. It can sometimes lag in giving signals. Like other technical indicators, it may give false positives or false negatives during sideways market movements. Keep these points in mind when using CCI in your trading strategies. Give a thumbs up if this was helpful and see you in the next video.